Hello, everyone, and welcome to another episode of the Swing Trader Status Update. It's Justin Nielsen here, and we are coming to you live at January 13th, 2026. It's a new year, a new us, a new you, everything else. And joining me today, of course, as usual, is Mike Webster, our senior market strategist and kind of the brains behind Swing Trader here. How you doing, Mike? Happy New Year.
Well, I'm not new. I'm the
Yeah,
same old, same
same
old,
old, same old.
the old
Um,
hippie from Austin.
There you go. So we're going to go through again. Look, rough quarter last quarter. I struggled, draw down much bigger than I would have liked. It was really tough getting things going, but we had earlier gains from the year that made it an outperformance versus the S&P 500. And now, new year, we're kind of not completely with a clean slate because we do still have those wounds from earlier, and we want to make sure that And also, I should say that once we got bought by Dow Jones, Dow Jones is on a fiscal year that starts in July, so we still have kind of our
Because that's normal,
yes,
right?
exactly, because our fiscal year performance. So we're still very aware of recent activity, and of course, it has been. Look, Januaries are typically a rough time. So, Mike, maybe that's something you can start out with and talk a little bit about what makes January tricky and how you typically approach it.
Sure. Bill O'Neill, the founder of IBD, would always say that if he was ever going to take a vacation, he would do it in January. You and I know, working so closely with him for as long as we did, he never took vacations. Even if he wasn't at home, he was still working. But that really told me something that early on the Januaries were something of different. There's so many cross currents. I know a lot of people do seasonality stuff, and people do the seasonality stuff can work if you're an algo. I don't think it works for a person, because if you go into a month and go, okay, July is going to be my best month, or July is typically my worst month, you go into that with that mindset of it's either going to be a great month so you're pushing it, or it's going to be a terrible month so you're really timid. And so I don't use seasonality for that reason. Not that I don't think it works, but I think it adjusts how you trade. But the reality is January is different because there are so many cross currents, and I wouldn't say it's a bad month. It's just a tricky month because you'll get so many whipsaws. We've been in a whipsaw type market for the last quarter, especially for this is like the kryptonite for our style of trading. Of things look good for 2 or 3 days, and then that sector gets hit just enough to stop you out, then to go higher just to frustrate you, and that's fine. Like, that happens with the market all the time. It'll go from at times where it's better to be a bottom fisher, better to be like a day trader, better to just be a Warren Buffett, and everything in between. And we've been in this choppy phase where what made the most sense is if you're a position trader, just sitting and holding things that were winning stocks. But if you're a swing trader, it just made it very difficult. It was difficult for me, difficult for the product. It is what it is. We did outperform for the year, not the way I would have wanted to, not ending the quarter the way, ending the year the way we did. We are, in line slightly above the S&P for the year, but even if we were down a bunch from it, it's only a couple weeks. You can't read too much into it. It's a marathon and all, not any one day or 1 week or 1 month or one quarter for that matter. But with this, you tend to get these whipsaws, and I think some of the groups. Let's pull up the IGV. Not something we've been trading recently, but I think this just kind of goes to show, it was in this downtrend, and then all of a sudden on the first day of the year, I think we talked about this on one of the recent SMTs that
Yeah,
we do on Fridays.
it was
That
that day.
Oh, okay.
Yeah,
That
because it
that
was a
was
Friday that happened.
Oh, okay.
Yeah.
So how much was that down? Like 3% ish, three and a
Yeah,
half
so
percent.
IGV was down 2.9%. And of course, by contrast, SMH, the very same day, up 3.7%.
Yeah.
And again, it was a very ugly day for the NASDAQ in general, a strong start, but horrible finish. So, yeah.
Yeah, so I think that was just illustrates how tricky it is because you look at the indexes and because they've got all the different sectors in there, you don't really see from that level, you don't see all the movements, and you had other head fakes like the XB. Let's pull up XBI, which I still think biotechs are a good place to be. It's just from a very short term swing trading standpoint. We tried it and then had to back out of it because it wasn't doing what we expected. We're still watching it to get back into it, but you have a big up day. Well, how much was that up day?
This one was
Yeah, so
3.55.
3.5%, and then the next day you get, down a whole bunch, and that's not if you're position trading, you can buy it on that day and you can give it all the way down to the 50 day to let it wiggle and wobble. But if you're swing trading, yeah, it's a different technique. You've got to cut it quickly. And so we had to cut that quickly. And so that hurt a little bit. And you're going to have this, and I think you're going to have it more so in early January than in any other time of the year. And what I do every time at the end of
Tax selling,
December,
especially after a big year, a
yeah,
lot of
you've
times
got the
does come into it, so
tax
yeah,
selling is a big deal, and you never really know how that is going to play out, and people who front run that or, like, try to game it
yeah,
and ahead of time. So it's the same thing, like, with when you're picking a stock that might go in the S&P and you think you're gaming it, and I think there was one at the end of last year that, like, didn't go up. I think it was, like, Hood or
fix.
something, or
No,
Fix,
no,
was it
yeah,
Fix?
I think it
Oh,
was
it was
Fix
Fix.
that, yeah, when it got added, I can't remember what the other 2 were, but Fix, it, like, just didn't
If
move
it
at
was
all.
it Hood that got added that was
Um,
up
I don't
that
know if it
day?
was this
I don't
time
know.
around, yeah, but,
It
and
all
Hood, I mean, look, a lot of people were anticipating Hood for so long, um, that it was kind of, like, disappointing each time it didn't get added, so, yeah,
Yeah,
it
so
was
you've got one of those things where it's really hard to game it other than to be what I've learned to do is to not to go in cash unless the market tells you to go in cash, but to dial it down in early January because let's do this. This is probably the easiest one. Go to the NASDAQ and go to December 31st of 99.
and just out of curiosity, I was trying to look and see, Carvana was the one.
Oh, it was
Carvana
Carvana. Okay.
was up big, I think on,
Was it the
uh,
gap up?
yeah,
Breakout day?
maybe, yeah. Um, so yeah, and
You
then
can
I
tell we're
think,
getting old because we don't remember,
right.
like, 20 years ago, we
But
go, "Oh,
yeah,
yeah, that was."
Fix didn't do anything on the day.
Yeah,
So okay, back to the Nasdaq.
and let's go to the end of the last day of 1999, last trading day.
Oh, need to be 2000.
No,
Excuse
no,
me.
no, go to last day of
Yeah,
'99, and then I wanna go out to 2 yeah.
yeah.
Okay, so here this is trending beautifully, like, this is one of the most powerful times since 1929, frankly, so, um, then and this is just an extreme case. Now let's go to the 1st day of January. And you get this weird movement, kind of like climaxy type of thing where it gets out of line to the upside, and you're like, "Wow, what would I make of that?" Now go out one more day.
And I'll just mention that Qualcomm was, you know, part of the reason for that, a very wild day for Qualcomm that day. But
Yeah,
back to the Nasdaq, and that was actually the peak for Qualcomm. Whoa,
I
2008.
hate when it does that. Yeah,
One more time. Let's try it again. And we'll go back to the third, and then
go forward
forward a
one day.
day.
So, I mean, look at it. That is so tricky because you wouldn't be expecting that type of move. And what I do every December is I look and I study the first quarter of each year and I focus in on the first 2 to 3 weeks of January and the last week of December. And I did do a Webby Rambles on my podcast, did an episode on that in December. So no need to watch it now. You can watch it next December. But that focuses on how I do that. That in the nutshell, what you the takeaway is just go light and dial things back early in January till you see how things go. Because sometimes you get these head fakes that then turn and go up. Just go out to the end of March, and then we'll be done with this. So if you would have just ridden off January, you would have missed out on a lot of opportunities because there were trades in there, and it went a lot higher. I mean, from 3,700 up to 5,000 in a blink of an eye. So you don't want to be scared of Januaries, but you just want to dial things back. So that's what we've done. We've kept our for the year. We even though there was a lot of heat out there that was moving, we've been heavy on the ETF. So we can go back to our current market. We've gone heavy with the ETFs. With the individual stocks, we're still starting them off as quarter positions. We'll revisit that in a little bit, and keeping them small and for the most part very tame, meaning low ATRs, because we wanted to get through the first 2 to 3 weeks and just kind of see where we were. We didn't want to continued being a drag versus the S&P. So we wanted to make sure we were in line with the S&P or maybe outperforming it a little bit before we started putting on the gas a little bit more. And we also really, I was hoping for the NASDAQ to take out those highs and move up, but it's kind of the laggard right now. Let's go over to IWM, which I
Yeah,
do
so
have a
the
position in.
24,000 level roughly. I mean, we really have kind of been in a base through this whole period, and I would argue that you could probably include this October 10th, as part of this overall base, because that's kind of really when it started. Even though we poked our head up into new highs at the end of October, it was kind of reminiscent of that October 31st. 2007 when you poked your poked your head into new highs just before getting whacked,
Wait,
and stuff.
wait, before you change the chart, I'm glad that you have it marked that way. I mean, this is why like we've been choppy and not doing well. Like with our style, something like this is the kryptonite. Now, with that, you can have rules around it and say, okay, you like wait until the low is above your 21 day for 3 days before you start pushing it. And that's some of the techniques that I use, or wait at least until your low is above it. But even with that, when it's choppy, where it goes up there for a little bit and then comes down and
That's
goes
almost
underneath
worse.
it. Yeah, because
You wait for the
exactly.
trend, and by the time it happens, that's exactly the time it starts going the other way.
Yeah, you can almost imagine it like a light switch, right? Like for me, getting above the 21 days, or like kind of with a dimmer, is like,
Mhm,
you're turning it on, and then when it's 3 days above it, it's like cranked up all the way. And then when you start going back down below it, you're flipping it off and then turn it back on. And like when you do that a lot, your lights are flickering. That's kind of what's happening with that 21 day. With my style, that's my kryptonite. Well, now if I use the 50-day, it would have chopped me up in there too. And so, unless you're using a 200-day, and if you're going to use the 200-day, nothing wrong with it, but that's not swing trading.
mhm,
That's
yeah,
something totally different. So, you want to stay within your style. It's kind of like music, right? Like if you're doing this, and let's say this is like Metallica, really fast. Well, that's going to be very different than if you're listening to like Frank Sinatra, like
mhm.
really mellow. And one's not better and one's not worse. Well, one is, but they're just different styles, right? So it's different styles, and you just stick with your style. You're not going to see, James of Metallica singing Frank, or if Frank were one of those the other way
I bet
around.
I bet James could rock it.
He
But
he
I
could.
like your dimmer switch analogy, because it reminds me, sometimes look, I've got a 4-year-old niece and a 6-year-old nephew that come over sometimes, and one of their favorite things to do is just do this with the light switches. And that's kind of what it's felt like,
Yeah.
with the market a little bit. Yeah, when you put them in charge of the lights, you get kind of a little bit of a mess.
And
So
there was a little Easter egg in that Frank Sinatra thing for people who
okay.
know, and I
All
won't
right.
even go there, but there's like one person who knows.
So
Um,
you wanted to look at the Russell again. By
yeah.
contrast, this was getting to new highs, and again, there have been a lot of times where the Russell 2000, the small cap index, has been set up, but it has trended for 3 days, and then that's been it. The relative strength certainly seems to be on an upswing right now.
It looks good until it doesn't look good, and that's been
Hmm.
the history of the IWM. So I don't, I'm cognizant of that, and but we're still playing it because it's been by definition the leading broad U.S. index recently, and you can just tell that by the RS line that you pointed out, and also the low versus the 21 day, and that's how I look at things is whatever the low is being able to get above and stay above the 21 day for the longest and the most consistent in patches because they don't stay above it forever but is IWM right now like contrast that with let's look at the Qs and quite different, right? It's just going all and over with that dimmer switch with
Hmm.
the 21 day and now let's go to FNGS which is your mega caps. And, that one has been, dogging it recently. If anything, it's really lagging, underneath the 21 day. 21 is kind of your ceiling and the 50 is kind of rolling over. So that's how I like to look at the mega caps, even though it's not a perfect index, it gives you a feel for what's working. So when you contrast those two, it's kind of like at the beginning when we were contrasting the SMH versus the IGV, you didn't really know how this was going to play out. And if the IWM had rolled over again and that
Hmm.
FNGS is ripped up, we would all said, "Oh yeah, that's what the game has been for the last X number of years."
Why would
Like,
it be different now?
why would it be? Yeah. So we're just taking it as it goes and going slow again, and probably until next week. We're kind of out of the woods a little bit because of the news out of the Fed. Now, I'm not going to. This is not a political show, so we're not even going to take any political take on this of what's going on with Powell in the White House. But how you interpret that in the market is when you get news like that, and the market brushes it off, because that is significant news. Like
Hmm.
what's happening with the Fed, and the fact that the market is completely blowing it off is telling you that the market is stronger than you think. Now, we don't know what the next thing is going to be, and there's going to be lots of headlines probably along with this, and maybe there is some dirt out there that he did do something wrong, or maybe there isn't, and you're going to get the gyrations as that news comes out. But at least
Or
at
even
first,
beyond that, there's a lot of geopolitical headlines that could come at any moment to, um, whack things. And there's, I think, enough things out there, which there almost always is, right? There's always that wall of worry of things where, oh, this could go south, this could go south. But at the end of the day, you kind of have to follow. Well, this is what the market's doing right now, and that's the best we can do is interpret the current market, not what we think might happen.
exactly. I guarantee you one thing, Justin. This year, there's going to be a lot of things to worry about. And
Yeah.
next year, there'll be a lot of things to
Right.
worry about. And the following year,
Yeah.
there's always things to worry about. So you know that, right? You don't want it to be perfect because if it's perfect, man, well, it's like 1929 and we're going down. Like you want things to worry about because that keeps shorts busy and then they have to buy back. And it's a good thing to have a wall of worry. Our job is to interpret the reaction to the news. And that was big, bad news. And the market should have been down 2 or 3% easily on that news, but it wasn't. It just completely ignored it for the most part. And that's good. And I think, it's helpful that he's going to be, is set to retire this year or, soon in a couple months, or at least as chairman. And then, so we don't know how all those dynamics are going to play out. Now, it could get really messy because there's some ways that this could play out that is not what we want to see. The market just wants it to be able to put in their spreadsheet,
Yeah.
okay, the Fed is going to do this. They don't care about the drama. They don't care about what party it makes it look better. It's just what number do I put in the spreadsheet for my interest rates?
Mhm.
Period. And the more uncertainty around that number, the more problematic it is. And so right now there's not that much uncertainty because I don't think anyone thinks he's going to do anything right now, unless the evidence is so overwhelming that everyone on the staff is like, yes, we need to do this. Right now, they're kind of just on a unofficial hold until he's no longer there. And I think that's a good thing for the market because then it can kind of price that in that no change. That's my interpretation. I could be wrong.
Mhm. I want to kind of, in addition to the small cap index, I want to address a few other things because
Sure.
RSP, the equal weighted S&P 500, has also been a recent area of strength. And look, it's very hard to get a lot of huge outperformance from RSP, and especially going back to the weekly, chart, you can see how this is just, especially since 2023, when it was the age of the Magnificent Seven, starting really in a big way. This has been in a serious downtrend. But look, just kind of looking at the comparison of what RSP has been doing and versus QQ, let's say QQEW, which is the equal weighted of the NASDAQ 100, very different picture. So it does kind of show how there has been a little bit of this move away from technology to a degree, but not so much that there's not technology stocks that are still really rocking to a large degree. So maybe talk a little bit about, again, it's great that we're getting breadth, but is it like kind of targeted breadth in a way?
Well, yeah, good point. So the QQEW, that looks like a mini base breakout failure because that's what it is. It tried to break out. That was a cup with handle that it tried to break out like 5, 6 days ago, stalled at new highs and came down. So at this point, it is what it is. It's a base breakout failure. It's not a broken chart. There's a difference between that. Like if it was down in the 139 range or 138, that would be a broken chart, but it's not a broken chart. It's what about half of breakouts will do. They'll pull back into the pivot area. Now, this is a little bit worse than you would like with something that's this slow, but it is telling you that that's not where the puck is right now. And it doesn't, based on that RS line, doesn't look like that's where it's going. Now, let's go over to RSP, which I do have a position in. And we have this on the list, and we've locked in a lot of our profits on it and just still keeping a remnant part of it, and we'll use that as a source of funds when needed, because like you were saying, it's going to underperform the S&P given any long amount of time. It just, unless the market completely changes its character and starts going to smaller and mid caps, it doesn't like the megas at all, this is going to have that bias because you're always going to have the Googles and things that, which I have a position in, that are are holding up and have that positive bias towards the market cap side of things, meaning the S&P or the SPY, which I have a position in. I just have to say that.
Mhm.
So with the RSP, when I'm looking at this, I'm going, look at that low versus your 21 day. Now let's pull up SPY. And with this one, the low is above it, but it's just barely above it versus now part of it is just the way the scaling is on the charts. But pull up the zero S&P 5 and let's see if that scaling is a little bit better. Okay, it's a little bit better. And you can see it's healthy. Certainly, let's pull up the Nasdaq again and just focus your eyes on the low versus a 21 day. And so this one totally different. It's yes, it's above it, but it was just touching it a few days back. So it's not really trending. That's how I like to look at trends. So the RSP, that's your breadth or your equal weight of the S&P 500. That one is looking much healthier, and that tells me it's still time to play out there. When that is running into trouble, and you have things, like that can't break out like this, then it's more of a reason to be defensive. So it's not, I don't think there's any reason to be defensive other than the time of year. Yes, we have all these news things, but there's always news things that can come out. We're we're at the mercy of that, no matter what month it is or what day of the month it is. But right now, I still think it's a time to be trading. But I'm spreading myself out personally more, and that's what we're doing with. swing trader right now, more on the heavy on the ETFs, which we're going to talk about in a few minutes. And as what I've always liked to do when you're starting out in a new trend or a new part of the year is I like to go heavy with the ETFs. And if I get traction in those, as I see stocks that are setting up in position, I will sell those off one by one. And I call it an SOF or a source of funds. I just use those, the ETFs, sell that to buy the stock because in that way I still have the exposure to the market until I find something. It's just a strategy I've been using for a few decades and it works for me. Are there drawbacks? Yes. The drawback is that if you miss some of those the heat right away, then you have to play, try to catch it out of position. And that becomes a, a real problem. Now, the upside is if the market had rolled over, you're in a more defensive place because you're more spread out, get hurt as bad. So, yeah, it's all about like kind of having the chips to spend or not. And when you have the chips to spend, you spend them or you can spend them and when you don't, which is kind of how I feel right now, even though we beat the S&P last year, that last quarter really isn't sitting well with me. And so I'm just having to be more conservative. And I just am saying that out loud so folks can, with your own trading, when you're not connecting on, as much as you'd like to, dial it back until you do. And that's just a strategy. We both saw Bill do it to varying extents. I got that from the book The Pitbull by Marty Schwartz. And my favorite part of it is when he talks about when things aren't connecting, it gets very small. And then once he starts having a string of winners, then he goes back to normal. And that's just the way I like uh, to trade.
Yeah, no, totally makes sense. Tim in the comments kind of read my mind here because as we were talking about the breadth with RSP and QQEW and IWM, one other place to maybe talk a little bit about the breadth is VXUS, one of the positions that we do have on SwingTrader. This is the Vanguard International stock ETF that is a global ETF minus the US. So this is kind of everything else except us. And why take a position in this? We usually are very US focused, although again, if there's a great stock in a foreign market, we're always open to that. But what attracted you to this one?
Good question, and thanks for bringing that up, Tim. If it's the same Tim I'm thinking of from Arizona, hey Tim, hope all is well. Um, I do have a position in this, and what was going on is we go through a bunch of ETFs. We've got about 100 or so ETFs that we go through, and a lot of those are specific foreign ones for different countries to just see what's going on. And I go through over that a few times a day to get a sense for are money flowing into these chips? Are they flowing into um, retail? Are they flowing into China? Are they flowing into wherever? And the foreign markets, specifically Europe, was looking really strong. And plus, you had the emerging markets looking strong and we are trying to decide which one to go with. And this one had such a low ATR that it met all the criteria we're looking for. It was broad based because you can't get more broad based than that unless you're looking at the total world, which would include the US. But we wanted to have something outside the US specifically as to diversify. And it was in position going up through to new highs. The low had been above the 21 day, basically had everything going for it, except you're not going to make a ton of money. But that's also where you're probably not going to lose a ton of money either, which is why we were doing it in early January. Now, I wanted to start taking profits in this already, but the reality is it was just trending nicely. And until we have something that really is perfect, there was no reason to do it. Now we might slowly start peeling back. Now, if it rolls over, we'll have to remove it, or reduce it. But right now, it's doing nothing wrong. Which brings up another thing that I wanted to talk about today was in 2026. given that a lot of 2025 was much better for position trading than swing trading, and until that changes, I'm going to be very open on this product to keep things much longer. We've done it a few times with a couple stocks, but not in any big way. But right now, until that changes, I'm going to be very open to leaving things on for a while. Now, what might happen is they might be remnants where we bring it down to like a 0.25 uh, a quarter position. So full position is 10%, quarter is 0.25 or 2.5%, a 2.5% position. We might lock it in, bring it down to that. And then if it sets back up, add it back, and then maybe get it up to a full or even beyond full, which we do at times. So just letting people who use the product know that you might see some of that, and we'll use the
And what's
21
the
day as our
just real quick,
guardrail. Yeah.
what's the benefit of having a remnant, as you say?
Oh, that's a good question. I do that all the time with my own trading. And Bill would do it too, as you saw. Sometimes he would just keep a little bit, and he was fine with that.
We often call
Of
it the token position, right?
the token, yeah, the token position that you have on your sheet. You're watching it all the time. You're more aware of it. But on top of that, even if you just have it in you could say all that stuff and have it in a watch list. If you've got a lower cost basis in there and you're adding to it, it's a lot easier to just add to that stock. You already have a built-in cushion, and we saw Bill do that with his individual stocks. He would do instead similar to LIFO, but he would do highest cost
Yeah,
as far as his selling. So let's say he's pyramided into a position and it's acting funny, or he wants to back away for some reason. He would sell off his highest cost stock, which is typically his last,
typically the last, right?
typically last,
Hmm.
and then bring it back down. And then he would always have this cushion, and he would always tell me, he's like, Mike, they can't take my cushion away, like easily, once
Yeah.
you have a cushion. Now it's different in swing trading terms and bill terms because his cushion was a massive,
Hmm.
massive cushion. We're just talking small cushions with swing trading. And so having that little bit on there gives you the flexibility. Let's say you have a quarter position and something sets up, you can bring it up to a 7.5 or a 10%, which would be full quickly. And if that isn't working out, but it's not broken, you can bring that back down to that remnant or the token of the quarter. No harm, no foul. You still have that on there. And I like doing that. I've done that, a lot over the years. It's psychological. If you're programming an algo, you wouldn't do that because
Hmm.
there's things that you do for psychological reasons and there's things you do for mechanical reasons. And sometimes they're both the same, they work for both. But this is more of a psychological. It's like, okay, I've got this stock and I've had it for X amount of time, and I've had a profit in it, and so I'm going to hold it. We're not going to hold a remnant of something we're down on. It's going to
Right.
be something that we're up on, obviously.
Hmm.
And then using that 21 day as our kind of our final line in the sand, maybe not a pierce of it, but a material close below it.
And look, there's no free lunch here, folks. So
Yeah.
one of the issues that happens is sometimes you do have a larger drawdown off the top when you're holding, and Eli Lilly is a good example of that. We had a trade on this that we were up significantly on. I think we entered here. And I just wrote about this for the Swing Trader column. Yeah, we were up 15%, and then this was just punishing. I mean, the expectation certainly was that you would have gotten some support, but it was just this slow grind lower until we eventually got below the 21-day moving average line. And we weren't waiting until that to exit, but that was our final exit when we got
Yeah.
below that, and then we ended up buying it right back,
Yeah.
because it kind of bottomed out and set up again. So.
So this is kind of a reason why I was saying now we still would have sold that underneath the 21 day down
Mhm.
there, like that, with the cost basis we had. Now, if we had the cost basis around more like 860 or 850 ish, then we might have been able to survive that. Probably not underneath the 21 day on a
Yeah.
swing trading product. Just the reality is we would now position trading totally different. Position trading product like a leaderboard, yeah, you wait for the 10-week line of a break of that once you have a gain. And I'll tell you, Bill, if he were with us, he'd still be in this and I think be in it in a pretty big way. Not a huge way, but in a big way because out of the gate, it had that initial move that gave him and it would have given him enough of a cushion to sit through. What he would have done is sold off that high cost basis. Anything, probably anything he paid over 1,000, he would have sold off, which is the same thing that we ended up doing with the swing trading, selling that off. But then probably would have piled back into it 4 or 5 days ago when it was breaking out and would have backed away from those. And that's so position trading and swing trading have so many similarities, but just different time frames and different amounts in there. But yeah, that was a very frustrating one. And that was one of the reasons, and I would do that same trade over again because it was one that I was planning on holding for a core move. Like I was that was the the intent with that, and that's why we let it go down longer than we would have if I was just thinking of this as a quick swing trade, then we would have just blown out the whole thing on that third day down off the top because at that point it was starting to act abnormal. Certainly the day after that, because that was more than normal selling. It was like, wow, that's really weird. I didn't foresee it doing what it did, but that would have told you time to back away from a swing trade. We made a conscious decision because of the quality of it and our intent. And I would do it over again. Like there's some trades that you do, you're like, what was I thinking? Like I would never do that trade over again. Other ones that just don't work out that you would do. And you always tell the analogy, the blackjack analogy, and I love it. And I would love hearing it from you. So you tell the blackjack analogy.
Well, people have heard it already. So,
Oh,
but
okay.
yeah, yeah. The idea is like, look, there are mechanics to it that you're never going to be getting your odds above the house unless you're counting cards or something like that. But if you want to get as close as possible, over the long term, because single instances don't really matter as much. There's a lot of randomness there. But if you're looking at over time, yeah, that means that if you are sitting on a 16 and the dealer has a 7 showing, you hit, even though a lot of the times you're going to bust. You know that going into it, that it's not a favorable odds position, but that's the way that you can play it to get your odds as best as they can in a losing situation. And same time, there are going to be you got pocket aces for poker, and yeah, that's a place where you're going to want to put your chips in, but you also know, depending on how the river comes out and the flop and everything else, the pair of aces starts out as the best hand, but it doesn't mean it ends as the best hand. So a lot of information comes out, and it changes the way you need to play the cards. And that's true of the stock market too. Doesn't mean when it goes against you, oh, you were silly to bet hard on pocket aces at the beginning. No, that's based on the information you had. So that's why we say sometimes that we would have done a trade the same way, even though now we have knowledge, right? But because we didn't have that knowledge at the time, just to be intellectually honest, you have to kind of think of what you knew at the time. So,
And that is
um,
so important. There's a reason to repeat it, just like Bill would repeat the did you buy fire insurance or the red dress story or the fish story, or the turkey story. There's these things that are so important to get down that it's worth repeating. And I think you do a great job uh, telling that one. So where do we have to go next?
you know what? Let's talk about a few other stocks that are kind of on our mind. Here's Reddit. I do have a position in
As
Reddit
do I.
here, and um, yeah, this is kind of your classic cup with handle, but it does have some flaws. There are some areas here where it was kind of running into resistance areas, a gap down. This certainly was not fun if you were holding it. But talk about why this got added, and you know the 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 good and the bad and the ugly.
Yeah, so I bought it back after we put it back on the list, and that's what I do. But like when I go my favorite names, I put on Swing Trader first, and then I'll wait the 30 minutes and put it on in my own account. Let's go to the weekly to kind of talk about why we're trading this one. Let's scroll down to the quarterly numbers. That's why we're trading it, because those are stellar sales growth and huge earnings on a percent basis. So that's why we like it. For that, I wouldn't be trading this if it didn't have that, because I don't think this is a beautiful base. If you go through and do a week, which we don't have time to do, but you study each week in that base, it is more negative than it is positive. What is good about it is that it's more constructive than its prior cup with handle that is too deep for us to for pattern rec, because pattern rec maxes out at 50%. And then this one, what was this is about 40%. How deep is this base?
39.
39%. So yeah, that's a deep base. And the one before it is super deep. Deep bases are not a sign of quality. It's a sign that people don't know what to pay for the stock. So when you
Mhm.
see something that's all over the place, one month it's 230, the next month it's 80, that's junk. It is what it is. I'm trading it. But that is by definition junk. Something can't go from 230 to 80 and not be junk in a blink of an eye. But it doesn't mean that things stay junk forever. It moved up, it's got the numbers behind it, it's tightening up. So now it's not as much junk, because when it fell down, it fell from the 260, 270 only down into the 170 or so. So yeah, it's got less of that problem on there. Now let's go to the daily. And I'll show you what I like about it is because I was buying it out of the cup with handle and it was shaken out a few days ago. And that's fine. I mean, I would do that trade over again, just like the 16 versus 7 that you were explaining. The it got What did it do? It got support exactly where it should have, right at the 21 day and in and around the pivot area, the standard pivot of the 246.15, that high point there, and really around its true alternative pivot, which was that big day up off of the 21 day. So it stopped where it should have stopped. So you had a bunch of selling in there. A lot of people sell breakouts, and that's what makes it so frustrating. So they sell it down, but you're getting some support there. So then when it goes back up, and because it was above its original pivot, the 246.15, that's why we wanted to play with it. And now we have a stop at today's low, or in and around today's low is where we will exit from a swing trading standpoint. If I was position trading this, I would give it all the way down to the low from 2 days ago. Um, but we're doing this with just a quarter position right now. And that's another way of we're mitigating our risk by the smaller position size, because it is a higher ATR than our other ones. It's our highest ATR, I think, in the portfolio, but it's not a super high ATR. We've gone with higher, but not in
Well,
January. Yeah.
to that end, let's go ahead and take a look, because we normally don't show our entire current trades list, because this is open for non-subscribers, and we usually leave that for subscribers. But we did decide, hey, it's a new year. We're going to show it this one time, so don't expect this every time. But this is what we have currently on the Swing Trader current trades. And the reason why we're showing this is because there's some important points on the what we call the ATR, the average true range. And we use, rather than a point system, we use a percentage. And the reason for that is because using a percentage, we can compare things against each other. If you use points, then you're going to get a very different ATR, a much higher ATR for a high price stock, and it's going to be very hard to do comparisons. So to your point, here are all of the stocks that we have and ETFs. Here's a 21-day ATR in this column right here. This is something that you can pull up on Market Surge. And yes, Reddit and Fix are the two highest. Those are the only ones above 4. GDX, even though it's an ETF, it's these have been movers lately, so it does have a higher ATR there at 3.4, and then Alibaba at 3.05. Our lowest ATR is RSP. I'm sorry, VXUS is the lowest, and RSP is next. So those are both below 1, meaning that on average, the move from the high to the low and take into consideration the previous day's close, in the case of gaps, um, is less than, it moves less than 1%, as opposed to something like Reddit that on a daily basis can move over 4% each and every day, on average. So that's a little bit of insight into when we talk about our portfolio ATR, which we have been keeping low lately, under 2, because of just how the market's been, how our performance has been. This is how it's been achieved, because we've been in a lot of ETFs that have um, been on the lower side. In fact, before we were in IWM instead of UWM. UWM, of course, is a double leveraged. I do have TNA myself. I'm in the triple leveraged on the Russell 2000. UPRO is a triple leveraged. We were doing SPY before, so these ATRs are a little bit higher than what we were doing, because again, we've been getting a little bit more traction, and so on. But we have a lot of low ATRs, and as Mike said earlier, some of these will probably be used as a source of funds when something better comes along. Then we're going to be shifting money, not because these are doing anything wrong, but oh, there's a better place to put that money. So we are also going to show some charts at the end that kind of show our breakdown in terms of our exposure. But I also wanted to mention, because a lot of people have noticed, well, gosh, there's a lot of ETFs in here. We actually are next week going to be doing a webinar, and this is more for beginners to kind of introduce them to the product. But yeah, we're going to be doing a webinar, and it's specifically on swing trading ETFs, why we've been using ETFs lately, and we're going to delve into that a little bit deeper for a 45-minute webinar. That's going to be on Thursday, 1:30 Pacific time, 4:30 Eastern time. So, anything on this that you wanted to kind of talk about?
Yeah, I will
And by
just
the way, I
say,
should say that this is in order of weights. So the highest weighted ones are at the top, and the lowest weighted ones. So you can see that, yes, these are very high weights. I mean, very high ATRs, but they are also only quarter positions. So not, we're mitigating our risk in that way.
yeah, and as usual, I have positions on all the things that we have on the list, and so with sometimes they're different leverage versions of what we have, but so I own all of these just for compliance reasons. So you can see this is very mellow. Yes, we've been 100% in and a little bit on margin at times, but we're doing it in a very mellow way, meaning the ATRs. And why we wanted to share this is I think everyone should do this with your market surge is put the 21-day ATR percent right next to it. So you're always looking at that and you're always cognizant of what that is, because sometimes you'll see a chart and you'll just forget to look at that. And in isolation, you can buy a something with an ATR of 10%, meaning it travels 10% in a day. But you can't do that if your portfolio is filled with those. Like we could do that right now, and the portfolio could handle it because it's so conservative. But we couldn't do that if the rest of it were a bunch of 8 ATRs. Like we just we would get chopped to pieces in something like that. So really be cognizant of your ATR. It's I think the best way of measuring risk. I don't use beta. I don't use other things. I think this is the best way of doing it. Is it foolproof? No, nothing is foolproof, but it does give you the reality over the last 21 days. I'm still looking for the one that's going to give me the reality for the next 21 days. Have you figured that one out yet, Justin?
Right,
I asked
exactly.
you
Yeah.
to. No, okay. But do this in in your portfolio and just always be aware of it, just like you know what your RS number is and your EPS number and your composite and so on. And expect this as we get traction. If we get traction or more traction, you'll see bigger numbers here. We're not going to be sharing this every month. We just thought it was a good way. We were going to just do a mock thing, mock portfolio and show some numbers in here, but we just thought, we'll just share it because most of the people that watch probably take the service anyways. But this is how this is how we're spreading it out, and you can see the Reddit and the fix.
Hmm.
Those are our tiny positions right now, but they also have the higher ATRs. If they start working, we'll add to them. Um, but oh, that does bring up another point. And did you have something else that you wanted to bring up?
Um, are you switching topics or
I
because
mean, kind
yeah,
of.
okay. So just a
But
few things in looking
yeah,
at the YouTube comments. Someone was asking if we do have a private video for subscribers. Not really. The problem is that they were never able to get it behind a paywall. So that's why it's kind of open to everyone. Um, if that's something that changes down the road, it's certainly something we could consider. But right now they just had a problem getting it to subscribers only. It's kind of just yeah, they couldn't figure that out. I also wanted to address something because Jason was mentioning that there's an issue with alerts, and so um, I have seen some folks put stuff in IBD Live that they were missing some alerts, and um, as far as I know, we still use Airship as our vendor. I did notice that I was missing alerts for a while, and they told me that was because I had an internal account. Um, and it was weird. I was getting my email ones, but I wasn't getting my desktop or phone ones, and then all of a sudden they came back. But they told me that was an internal thing. So for anyone that is having alerts issue, because the reality is Mike and I, um, we don't know. That's kind of back end stuff on the technology side. So if you could maybe reach out to our customer success department and let them know, because they can kind of track and say, oh, this is something that's a one-off, because again, they told me I was a one-off. But if it's, hey, a bunch of people are calling, and I asked them, I said, look, this is happening to me. Is it, is it happening to a lot of people? And they were like, no, we're not seeing it. But if this is something that's happening on the alert side, we certainly want to make sure you're getting the alerts if we're going to
yeah,
spend the
that's
time.
really
Right?
important.
Yeah.
Please,
So I mean,
yeah,
that's
please,
where subscribers do get the benefit, right? You're getting these alerts throughout the day. So yeah, it's important that you get them.
yeah, please definitely reach out to the. Sometimes we've got some weird things where like people are on like do not email lists, and so that like please reach out. We've got a great customer service staff or customer. What are they called?
Customer
Uh,
success. Yeah. Hmm.
Success.
Yeah.
Um,
Mhm.
so, great group of people. So reach out to them and they'll walk you through it. I'm always looking because um, Justin and Julie will be the ones that actually send the alert out, and I'll always be looking on my phone to make sure that it it comes through. If not, I'll send them a message that I didn't get it. So I'm always looking.
Sometimes it's
Um,
like, hey, are you guys awake over there? Did you see that? Type thing.
Well, no,
Like,
look, we're all busy,
yeah,
man.
yeah.
Like we're all doing a million things. So one that we're there
And
are other.
sometimes we don't get the message, yeah, because we communicate a lot through Slack, and sometimes, yeah, the notifications don't go up like they think they should. But anyway, yeah,
So the other thing that I wanted to
and not too long because we're already running late. So
oh,
just
sorry.
no,
Um,
no, it's okay. Just we have to get to our other charts too.
Oh, that's right. So I
Yeah.
want to be just, we always like to use these to let people know kind of what our plans are. One, once we start getting a little bit more traction, probably, outperforming the S&P for, 3 to 5 days for the year um, in a row, in a comfortable fashion, then we'll probably start increasing our starting positions, which right now our starting positions are a quarter and a half, meaning a quarter for individual stock, half for ETFs. And we will switch that to back the other way with half and full, meaning half for individual stocks, full for ETFs, or 5 and 10%. And we'll send out an alert or whatever. Just read the alerts, and you'll see what the starting size is.
Hmm.
I just want a little bit more comfort that we're moving in the right direction before we start increasing that risk. And then the other thing is, I've been excluding a lot of stocks because there hasn't been a clear stop. By clear stop, I mean the low of the day is a clear stop, the low of the prior day is a clear stop, or the 21 day. Lots of times they're more than 5% away on the powerful ones that look good. And we're just letting them go because I'm going, man, if we use this, the low of the prior day is 7% away. That's too low. And in reality, what I would do with my own account is just say, okay, I'm willing to take a 5% risk on this or 4% risk or one ATR. Let's say it trades 3% on average. That's its ATR. Put the stop at 3%. We're going to start doing that because we're missing too many good ones because the low of the day or a logical place on the chart is just too far away. So just be paying attention to where we put those alerts. Now, also keep in mind that the levels that we tell you aren't always the levels that we act on because we don't want to totally put our we just want to give you a general place that we're planning on stopping at. Sometimes we want to do it before that for various reasons for the portfolio. If everything is coming down, we need to reduce exposure. We'll cut it before that, or sometimes a little bit after that if it's looks like it might be a little bit of a shakeout. But at least you'll have that. So, in a nutshell, just expect, pay attention to what our stops are on there, because they're not always going to be at the low of a day. They might just be 4 or 5% below our starting point. And if the stock isn't acting right, we don't have to let it go all the way down that much. Bill would he was not a swing trader; he was a position trader, and his max stop loss was 7 to 8%, but his average stop loss was 3.5%. So kind of in that same vein, we might say that put our stop at 5%, but on average selling it at 2 or 3%. So wanted to let everybody know about those two changes.
Yeah, perfect. And yeah, to Mike's point, of course, we have had again a rough quarter. This is kind of the
Mhm.
September 30th right here, and things. Here's October 10th, and we had a number of times where we were, the just for folks that aren't familiar with this chart, the yellow line is our 10-day moving average line on our equity curve, and the blue line is our 21-day moving average line on our equity curve. The purple line, of course, is the equity curve itself. So yes, a lot of outperformance, mostly because we sidestepped the whole tariff tantrum in March and April. That gave us a huge gap above the S&P 500. But as we said back then, we know it's not going to, it's not going to last, right? Eventually, the S&P 500 will come back, and it's sometimes tough to maintain that gap of outperformance, especially when you're out and then the S&P 500 starts roaring back. Sometimes it's you take a little bit take a little bit of time to get ramped back up. More recently, we did have a number of cases where, oh, okay, we're starting to make traction. We're kind of breaking above our downtrend in our equity curve, and so we were willing to go a little bit heavier. A lot of those times we got smacked back down very quickly, and again, that's just been a function of the quarter. Each time we were kind of starting to make progress, we'd get smacked back down. So to be determined what this time is like. But right now, again, we're looking like we're breaking the downtrend of our equity curve back above our
We're
moving
putting in a
average lines.
bottoming base.
Yes, exactly. There we go. A couple other charts that we want to show, the portfolio ATR. I marked this time the 4% level and the 2% level. We certainly have been below the 2% level, kind of going into the end of the year and the beginning of this year. Again, a little bit of a function of what Mike was talking about earlier, where, just because of the trickiness during those time periods, and there's a lot of variables that go into it. So not only that, but because of the way our equity curve was, because of how challenging the fourth quarter was, the quality of setups and et cetera, that's been on the lower side. However, because again, we started making progress, we got above our moving average lines for the equity curve, we are allowing ourselves to go back above 2% of portfolio ATR. And we did do a webinar on that before, where we went into some depth on calculating the portfolio ATR, how to do that and everything. But yeah,
That
that's
was
where
a
we're
that
at.
was a normal one of your podcasts, or was it a webinar that we did on
I think it
that?
was a podcast. Yeah, I think it was a podcast actually where we covered that. We've covered in a couple different places, so that's why I can't remember.
Well,
Yeah.
I will say people who follow take the product and follow it. If you want to know how aggressive we're being, it's not about percent invested, it's about the portfolio ATR. Percent invested, yes, that is important, but it's really about the portfolio ATR because you could be 150% invested, meaning 50% on margin, and have a relatively low portfolio ATR. Or you could be 50% invested, 50% cash, like only 50% invested, and be in a much riskier position with having a much higher portfolio ATR. So the percent invested isn't necessarily the best way to look at your risk in the market, in my opinion. It's really the portfolio ATR. Now, that's excluding things like your stock is about ready to have a risk event, like an earnings or something where the if your ATR on your stock is 4%, but you're going into earnings and it normally goes up or down 20% on a day, well, that 4% means nothing. You've got a 20 ATR or a 30 ATR on that stock. But without the earnings, that this is what I focus on. I mean,
Mhm.
more than anything, like above all, any indicators that a specific stock is telling me to buy or sell or whatever, I'm looking at our portfolio ATR, and then all the other decisions come from there. If we need to increase or reduce it, or it's about where it should be. Right now, it's about where it should be, and it could increase as long as we continue making progress. Expect that line to go up. If we stop making progress, that bottom line down there will be going right back down underneath too.
Mhm. And as a reminder for some folks that may be not familiar with the way this equity curve is is created, with all the alerts that we send, we basically treat that as a model portfolio. So we tell you what the position size is, a quarter position. We're always using the value of the portfolio the previous day. That gives us a share amount, and then um, when we decrease it or add to it, we make those adjustments based again on the position size that is stated, the price at the time of the alert. Um, and again, if you're not getting alerts, please do contact customer success. We want to make sure you're getting those if you are a subscriber. Also, I want to address that a few folks are mentioning in the and this happens almost every time, that they're getting a lot of ads on this video. That's YouTube. If you are on our we will be putting this from YouTube where we're going live onto our site at investors.com, and then those ads will be won't be there for that. If you are getting ads, if you don't want to get ads, YouTube does have a premium, you have to pay for it, subscription, and that takes the ads off for you. But yeah, those ads are YouTube ads that you're seeing.
I
So
will just say,
apologize, I know it's annoying for folks, but
I will just say the YouTube premium is worth it. I pay
I've had it
for
for
it.
years. Yeah,
Yeah.
I don't even think about it. It's just, yeah, because I don't want to sit through ads myself.
Yeah.
It would drive me nuts, especially because I know sometimes they don't put the ads in a place that's a natural pause. It's like it right in the middle of something. So,
Yeah.
yeah,
But sometimes like my better half is fine with commercials on stuff that she watches because then she checks her phone. So it's
yeah,
just whatever works for you. But
yeah.
I pay for the premium.
Yeah, and I do that with a lot of Amazon Prime. What I think it's like
Yep.
$2, Peacock, whatever. So, I also wanted to show
Oh,
kind
don't
of.
forget Landman. That's on
Oh
Paramount
yeah,
Plus,
I
right?
haven't
Man, you
gotten
got
to. We're watching Medici right now because we're going to Florence, Italy, in a couple weeks. So
Oh, you're so special.
yeah. So okay, sector weights. So we kind of approach this two different ways this time around. Just to kind of show, normally we will show, oh, this is our ETFs, and we'll say, oh well, GDX, yes, it's an ETF, but we kind of put that in the gold miners, section. So we kind of show exactly where we're invested. But if it's a broad-based ETF, we'll just call it an ETF. So this is 86% of our invested percentage is in ETFs right now. And you can see how the rest is spread out. But if you take a look at where those ETFs are, it's a lot more evenly spread out. So we have, of course, our small cap exposure, we have our large cap exposure, we have our gold miner exposure. These are all just ETFs, right? For our home builders, we have ETF and stock. For international, this is our this is ETF exposure here. China, we have both ETF exposure and an individual stock. So the graph really looks very nicely evenly spread out almost.
Yeah.
And again, that's by design.
Almost
That's
like it
kind of
was done on purpose. Yeah.
yes, almost, almost. So yeah, so those are our charts there. I also want to just kind of wrap up because we did put in the tweet a couple extra. I know we covered fix to a degree, when we were talking about when the S&P 500 ad had happened. This was a new ad today. Again, this was poking its head above 1,000 a couple times, but like
I
the
can't see
market,
your
this has
chart.
been. Oh, sorry about that.
Yeah, it's okay.
I can see it, and I'm marking it up
Sometimes
for
there is a
everybody.
delay before it
Yeah.
pops up, and I'm like, "That's a long delay." There it is.
No, yeah, there we go. So yeah, this 1,000 level popped its head up above it a couple times, but we gave this another try, and yeah, it's popping up. Again, this is a higher ATR stock, so we went with a smaller position size. Um, Anything to add on the fixed chart?
No, as I said, I have a position in that, and what I do like about it is the same thing I don't like about it is I don't like how choppy it's been in this base. I mean, it's like being nice calling it a base, and like, it's
Mhm.
so sloppy. Um, but what I like about it is this last sloppiness that happened like 4 days ago. Again, it was kind of like the other one we were looking at, the Reddit. It came down, stopped exactly where it should have, right at its 50 day, we're in and around the 21 day, and then turned and went up. And this is the time where it's not an ascending base. It's not ascending base. It's not ascending base. So don't write me the letters that I don't know what ascending base is, but it's in the spirit in that you had your first chunk there with 1,020.26, that little basing area. Then it kind of did this little mini like base on top of it that held above that. Then it formed this last little thing, which is very typical of an ascending base where your first two are about the same in depth and length, which those two are, and your last one is short and shallow, which this one is. So it's in that spirit. It's not an ascending base. It's not an ascending base. Hopefully, I made that clear, but it's in the spirit of it. So that means today was the breakout of that, looking at through that lens. So if it breaks down from there, we'll exit it. If it moves up, we might add to it. It might have too high of an ATR to add to it up here, which Justin and I were talking earlier about like where we're going to add to some of these. And sometimes you're not going to be able to add to them because it'll run the cost up too high versus where your stop is. So sometimes you'll see these token positions stay token positions just because there's not a logical place to add unless we get an upside reversal or something where we're still up on the stock and it gives us another entry or goes sideways and gives us something to go off of. We might just have to have some of these small positions stay small.
Yeah, and
And I
that's the
think
part of the
we've gone kind of
yeah.
so. Go ahead.
Well, I was just going to say that's part of the balancing act, right? Where, yes, we could add to these because they're working, but when you've got a higher ATR, you also run the risk of, okay, if it does correct, and now you've loaded up on it, you're gonna take a harder hit there. So, yeah, that is that's a challenge. One more that we again put in the tweet, so I want to make sure we covered that. Walmart. Um, Here's that one. And yeah, broke out recently after hugging its 21-day moving average line for a while. Pretty impressive that such a large company can still move like this. That's something that we've seen a lot. And I think you've talked about the benefits of a Sam's Club membership and how you can just walk out of the store as
You
something
still have
that's
to pay
very
for it, but
yes, yes, yes. You
you
can
don't have
walk
to
out of the
deal with them.
store, and you don't have to go to the register. But yes, you still do have to pay for it. They just make it more convenient to pay for it and take that money from your wallet. So,
Yeah, and I do
uh,
have a position in this. I like it, but I also like that it's slow and pokey, because we wanted to have some exposure to this space. And we, just this was a slow and pokey place to do it. It would have been better on that upside reversal like 4 days ago, but we just didn't have it didn't make sense in the portfolio at that time, and so we decided to not let it go. But hey, I know we're way over time, but I just
Yeah,
did
someone
want to
was saying
say,
maybe a 3-hour show today. So
yeah, I'm always down for that, just like a good Grateful Dead show. And I did want to say to all the Deadheads out there that are with me, dealing with losing Bob Weir, who anyone who watches the SMT videos on Friday knows that every Friday I mention Bob Weir. I don't know anyone else in the financial world that talks about Bob Weir on a regular basis, and just his passing has hit me hard, and I'm sure it's hit a lot of people hard. And so just take every day for the blessing that it is and enjoy it, because we're not guaranteed to live forever. So my thoughts and prayers are with all the deadheads and Bob's family.
yeah, very good note to end on. And thank you very much, Webby, for all your insights. We will, of course, typically be here for you on the second Tuesday every month. So that means my expectation is, if that holds true, sometimes we have to change things around for scheduling purposes, but we'll be seeing everyone on February 10th, most likely. So thanks a lot for watching. Really appreciate it. Thank you, Webby. And that's going to wrap it up for us this time around. Don't forget to join us for that Swing Trader webinar that we have coming next Thursday on the 22nd of January at 1:30 p.m. Pacific time. So hope to see you there. Take care, everybody. Have a good one.